Right now, something extraordinary is happening in the silver market. And if you're not paying attention, you could miss one of the most significant wealth building opportunities of the decade. But here's what makes this different from all the hype you've been hearing. What I'm about to share with you isn't speculation. It's not predictions. It's documented market data from the world's largest exchanges, confirmed by industry reports, and it's happening right now as you watch this video. Before we dive deep, do me a favor, hit that subscribe button and turn on notifications. Because what's unfolding in the silver market is moving fast, and you'll want to stay updated as this story develops. I'm going to break down what's really happening, why it matters, and most importantly, what it means for your financial future. Trust me, you will want to stick around for this entire video because the information I'm sharing gets more critical with each passing minute. So let's talk about silver. For most people, silver is just that shiny metal used in jewelry or maybe some coins their grandfather collected. But here's what most people don't understand. Silver is one of the most critical industrial metals on the planet. And right now, the silver market is experiencing something that hasn't happened in modern financial history. We're witnessing a fundamental shift in how this metal is priced, traded, and valued globally. Here's the situation. The world is using more silver than it's producing. This isn't a temporary blip. According to the Silver Institute, the global silver market has been in a supply deficit for 5 consecutive years. Let me repeat that. 5 years in a row where demand has exceeded supply. In 2024 alone, the world consumed approximately 1.17 billion ounces of silver, while only producing around 1.01 billion ounces. That's a deficit of over 200 million ounces in just 1 year. When you add up the deficits from 2021 through 2025, we're looking at a cumulative shortage of almost 820 million ounces of silver that simply vanished from global inventories. Now, you might be thinking, okay, supply and demand imbalances happen all the time in commodities. What makes silver different? Here's what makes this absolutely critical. Unlike other commodities where high prices eventually bring new supply to market, silver doesn't work that way. Here's why. About 71% of all silver mined globally comes as a byproduct from other mining operations. Companies mining for copper, lead, zinc, and gold happen to extract silver along the way. This means that when silver prices go up, it doesn't automatically lead to more silver production. Miners aren't opening new silver mines. They're making decisions based on copper prices, zinc prices, and gold prices. Silver just tags along for the ride. This creates what economists call inelastic supply. When demand for silver skyrockets, the supply can't respond quickly enough. And right now, demand is absolutely exploding. Let me show you why. Industrial demand for silver now accounts for more than half of all silver consumption globally. And it's not just any industrial demand. We're talking about technologies that are defining the future. Solar panels require approximately 20 grams of silver per unit because of its unmatched electrical conductivity. As the world pushes toward renewable energy, solar installations are breaking records year after year. Electric vehicles use up to 2 ounces of silver per car in sensors, wiring, and power management systems. The electronics industry relies on silver for semiconductors and circuit boards. Medical devices use silver for its antimicrobial properties. Here's the kicker. The International Energy Agency estimates that by 2030, just the solar and electric vehicle sectors alone will consume half of the world's entire silver production. Think about that. 2 industries will eat up 50% of supply, leaving the jewelry market to the investment market, and every other industrial use fighting over what's left. And here's what makes this even more critical. You can't substitute silver in most of these applications. Companies have tried. They've researched alternatives. But silver's unique combination of electrical conductivity, thermal properties, and malleability makes it irreplaceable in high-performance applications. When you're building a solar panel or an electric vehicle, you pay whatever silver costs, because without it, your product, it doesn't work. Now let's talk about what's happening in the physical market, and this is where things get really interesting. If you go to major bullion dealers right now, like COMEX, one of the largest precious metals dealers in the United States, and you look at their prices, you'll see something fascinating. Spot silver, the theoretical price that trades on exchanges, might show around $72 to $79 per ounce. But when you actually try to buy physical silver, you're not paying spot price. You're paying what's called a premium over spot. And these premiums have been climbing to historic levels. For example, a basic 1-ounce silver bar round, the simplest form of silver you can buy, typically carries a premium of $3 to $5 over the spot price under normal market conditions. But in recent months, dealers have been charging premiums of $8 to $12 or more over spot for basic products. American Silver Eagles, which are U.S. government-issued coins, have carried premiums of $15 to $20 above spot. Even wholesale products like 100-ounce bars, which usually trade very close to spot because they're bulk products, have been selling at significant premiums. What does this tell us? It tells us that the real market clearing price for physical silver is significantly higher than what the paper market suggests. Think about it this way. If you wanted to buy a silver bar today, you can't actually buy it at the spot price shown on financial websites. That price is a reference rate based on futures contracts and large wholesale transactions between banks and refiners. When you are a regular person, or even a smaller institution trying to buy actual metal in your hands, you're paying anywhere from 10 to 25% more than spot, depending on the product. This spread between paper prices and physical prices is called a premium. And when premiums widen dramatically like we've seen recently, it's a signal that physical metal is becoming scarce. Now here's where the story gets even more compelling. Let's talk about what's happening in the world's major silver trading centers. The two most important silver markets in the world are London and New York. London, through the London Bullion Market Association, handles enormous amounts of physical silver trading and vaulting. New York, through the COMEX exchange, which is part of the CME group, is where silver futures contracts trade. These two markets are supposed to work together seamlessly, with metal flowing between them to equalize supply and demand. But something unusual has been happening. In late 2024 and early 2025, silver inventories in London dropped to levels not seen in years. We're talking about inventory declines of millions of ounces as physical silver was being pulled out of London vaults at an accelerating pace. Where was it going? Much of it was flowing to Asia, particularly to India and China, where demand has been surging. Indian consumers, who have a cultural affinity for precious metals, have been buying silver aggressively despite high local prices. Chinese industrial demand has been relentless as their manufacturing sector, particularly in solar panel production and electronics, consumes massive quantities of silver. When London's inventories started dropping, something remarkable happened. Silver lease rates, which are essentially the cost to borrow silver in the wholesale market, started spiking to levels not seen in decades. In September 2025, silver lease rates shot above 5%. Under normal market conditions, silver lease rates are close to zero because there's plenty of metal available to borrow. But when lease rates spike to 5% or higher, it's a clear signal that available physical silver is getting extremely tight. People who own physical silver are demanding a premium to lend it out because they know it's valuable and scarce. Meanwhile, over in New York, something interesting was happening at COMEX. Early in 2025, COMEX warehouses saw a massive influx of silver. Inventories surged to near record levels with over 526 million ounces stored in COMEX-approved warehouses by October 2025. Why the sudden buildup? It had to do with U.S. trade policy. When silver appeared on a draft list of critical minerals that might face import tariffs, traders and industrial users panicked. They rushed to import silver into the United States before any potential tariffs could be implemented. The result was an unprecedented stockpiling of silver in American warehouses. But here's what happened next, and this is crucial to understand. Even though COMEX had record inventories, the amount of registered silver, which is metal available for immediate delivery against futures contracts, started declining rapidly. In December 2025, something extraordinary occurred. Over 47 million ounces of silver were claimed for delivery from COMEX in just the first 4 trading days of December. That represented more than 60% of COMEX's total registered inventory being claimed in less than a week. This wasn't normal market activity. This was a rush to convert paper contracts into physical metal. Why would someone take delivery of physical silver from COMEX instead of just rolling their futures contract forward or settling in cash? Because they don't trust the paper market anymore. When institutions and sophisticated traders start demanding physical delivery en masse, it's a vote of no confidence in the futures system. They're essentially saying, we don't want your promises, we want the actual metal. And when this happens at scale, it puts enormous stress on the exchange's ability to deliver. Now, let's talk about something that has been developing in Asian markets because this adds another layer to the story. While Western markets like London and New York have been dealing with inventory challenges and delivery pressures, Asian markets have been in aggressive buying mode. China, in particular, has been implementing policies that effectively keep more silver within its borders. Through new export licensing requirements, China has made it significantly more difficult for smaller refiners to export silver. They've set minimum production thresholds that only large companies can meet, which has the effect of trapping supply inside China. Why would China do this? Because they understand what's coming. China is the world's manufacturing powerhouse for solar panels, electronics, and electric vehicles. All of these industries are massive silver consumers. By implementing what's essentially a soft embargo, restricting exports without officially banning them, China is building a strategic reserve of silver. They're ensuring their industries have access to the metal they need, while Western countries and their industries face tightening supply. This is resource nationalism playing out in real time. And it's not just China. Other Asian countries have been actively buying and stockpiling silver as well. What this creates is a fragmented global market. You have London experiencing physical tightness with low inventories and high lease rates. You have New York with large inventories, but facing delivery pressures as traders convert paper to physical. And you have Asian markets aggressively accumulating silver and implementing policies to keep it from leaving. These dynamics are putting upward pressure on prices globally, but they're also creating disconnects between different markets and between paper prices and physical prices. Now, I need to address something that's been circulating in the silver community, and I want to be completely transparent with you about what's real and what's exaggerated. You may have seen videos claiming that silver is trading for $130 in Tokyo, $115 in Dubai, and $110 in China, while only $73 in New York. These claims suggest a massive global price fracture. Here's the truth. While there are premiums in different markets, and while physical silver does trade at a premium over paper prices, the differences aren't as extreme as some content creators claim. These exaggerated price disparities are often based on misunderstandings about how prices are quoted, currency conversions, or selective examples from retail markets that don't represent wholesale prices. However, and this is important, the underlying concern that these videos are tapping into is real. There is genuine tightness in physical silver markets. There are real premiums being paid. There are real inventory drawdowns. And there is a real disconnect between paper markets and physical availability. The situation is serious enough without exaggeration. You don't need to manufacture a crisis when the actual market fundamentals are this tight. So what does all of this mean for silver prices going forward? Let's think through the logic here. You have a market that's been in deficit for 5 straight years. You have inventories that have been drawn down significantly. You have industrial demand that's not just strong, but growing and relatively insensitive to price, because silver is such a small component of the final product. When a manufacturer is building a $40,000 electric vehicle, paying an extra $20 or $30 for the silver content isn't going to stop production. You have investment demand starting to awaken as people recognize the supply situation. And you have structural issues in the mining industry that prevent rapid supply response. What happens when you have sustained high demand, declining inventories, and inelastic supply? Economics tells us that prices have to rise until demand destruction occurs or new supply comes online. But here's the problem. Silver demand is hard to destroy because so much of it is industrial and mission critical. A new supply takes years to bring online, even if companies wanted to open new silver mines. This sets up a market dynamic where prices can rise significantly and stay elevated for an extended period. Now, some analysts are projecting silver could reach $100 per ounce or higher in the coming years. Is that guaranteed? Absolutely not. Markets are complex, and unexpected events can always change the trajectory. But when you look at the fundamentals, the supply deficit, the industrial demand growth, the inventory drawdowns, the case for significantly higher silver prices becomes very compelling. And here's something crucial to understand. If silver does move to $100 or beyond, it won't be because of speculation or market manipulation. It will be because industrial users are willing to pay that price to keep their production lines running. It will be real demand for a scarce resource. So let's talk about what this means for you as an investor or someone interested in precious metals. If you believe, as I do based on the data, that silver is entering a long-term bull market driven by fundamental supply and demand dynamics, how do you position yourself? There are several ways to gain exposure to silver, and each has its own advantages and risks. The most straightforward approach is owning physical silver. This means buying coins, bars, or rounds from reputable dealers and storing them securely. When you own physical metal, you have direct ownership of an asset with intrinsic value. If the global financial system faces stress or if supply becomes even tighter, owning physical silver means you actually have the metal, not a promise to deliver metal. The challenge with physical silver is the premium you pay over spot, which, as we discussed, can be significant right now. You also have to deal with storage and security. But for many investors, particularly those concerned about financial system stability, owning physical metal provides peace of mind that paper assets cannot match. If you're going to buy physical silver, do it through established dealers with good reputations. Companies like COMEX, SD Bullion, JM Bullion, and others have been in business for years. Be aware that premiums vary by product. Generally, larger bars have lower premiums per ounce than smaller bars or coins. But coins like American Silver Eagles or Canadian Maple Leafs have better liquidity and are more easily recognizable, which can make them easier to sell later. Another option is silver ETFs, exchange-traded funds that track the price of silver. The most popular silver ETF is SLV, the iShares Silver Trust. When you buy shares of a silver ETF, you're buying a claim on silver that the fund holds in vaults. ETFs offer convenience because you can buy and sell them like stocks in your brokerage account. You don't have to worry about storage or security. The downside is that you don't actually own physical metal. You own shares in a fund that owns metal. In a crisis scenario where you wanted to convert your ETF shares to physical silver, it's not a straightforward process and may not even be possible for most investors. There's also the question of whether these funds actually have all the silver they claim to hold. Most reputable ETFs are audited and do have the metal, but there's always some degree of counterparty risk. You're trusting the fund structure and the custodian holding the metal. For investors comfortable with this, ETFs provide an easy way to gain price exposure to silver without the hassles of physical ownership. A third option, and one that many sophisticated investors are looking at carefully right now, is silver mining stocks. When you invest in a silver mining company, you're not just getting exposure to the silver price. You're getting leverage. Here's what I mean. Let's say a mining company produces silver at an all-in cost of $20 per ounce. If silver is trading at $30, they're making a $10 profit per ounce. Now, if silver doubles to $60, they're not making double the profit. They're making $40 per ounce in profit, which is 4 times what they were making before. This leverage effect means that mining stocks can significantly outperform the metal itself during bull markets. Of course, the flip side is that mining stocks also have more risk. They're subject to operational issues, management decisions, political risks in the countries where they operate, and broader stock market volatility. Mining stocks can be volatile, and not all mining companies are well managed or have good assets. But for investors who do their homework and select quality companies with good management, strong balance sheets, and solid assets, silver mining stocks could potentially deliver outsized returns if silver enters a sustained bull market. What is particularly interesting right now is that many silver mining stocks haven't fully priced in the recent gains in silver prices. The market seems skeptical that these prices will hold, so mining stocks are trading at relatively modest valuations compared to historical norms for the current silver price. If the market comes to believe that higher silver prices are sustainable, there could be a significant revaluation of mining equities. I'm not going to recommend specific stocks in this video, but if you're interested in this space, look for companies with low production costs, strong balance sheets, growth potential through new projects or exploration success, and management teams with good track records. Now, before you rush out and put all your money into silver, let me give you some important cautions. First, diversification matters. Silver should be part of a balanced portfolio, not your entire portfolio. No one can predict with certainty where any market is headed, and putting all your eggs in one basket is rarely a good idea, no matter how compelling the story seems. Second, understand your risk tolerance and investment timeline. Silver can be volatile. If you're going to invest in silver, particularly through mining stocks, you need to be comfortable with price swings. This isn't a get-rich-quick scheme. It's a long-term play based on fundamental supply and demand dynamics. Third, be careful about where you get your information. The precious metals space attracts a lot of hype and misinformation. Stick to reputable sources. Look at actual market data from exchanges and industry organizations like the Silver Institute. Be skeptical of extreme claims or predictions. Focus on understanding the fundamentals rather than chasing price targets. And fourth, understand the mechanics of whatever vehicle you're using to invest in silver. If you're buying physical, understand premiums, storage, and insurance. If you're buying ETFs, understand the fund structure and fees. If you're buying mining stocks, understand the companies you're investing in. Knowledge reduces risk. Let me share with you what I think the most important takeaway from all of this is. What's happening in the silver market right now is a case study in supply and demand fundamentals playing out in real time. This isn't about market manipulation theories or conspiracy thinking. It's about basic economics. The world is using more silver than it's producing, and this imbalance has been going on for years. Inventories are dropping, industrial demand is growing, and supply can't easily increase. These are facts supported by industry data and observable in market behavior, like rising premiums and delivery pressures at exchanges. Whether you decide to invest in silver or not, understanding these dynamics is valuable because it illustrates how commodity markets work and how supply and demand imbalances eventually resolve themselves through price adjustments. We're likely in the early stages of a major repricing of silver as the market adjusts to recognize the reality of tightening supply and growing demand. This doesn't happen overnight. It's a process that unfolds over months and years. But for those paying attention and positioning themselves appropriately, it could represent a significant wealth-building opportunity. The silver market is telling us a story right now. It's a story about the transition to renewable energy, about the electrification of transportation, about the digitization of everything requiring more semiconductors and electronics. It's a story about resource scarcity in a world that is consuming materials faster than we're discovering and developing new sources. And it's a story about the disconnect between paper markets and physical reality, a theme that shows up not just in silver, but across many commodities and assets. As we wrap up, I want to encourage you to stay informed about this market. Whether you're an investor or just someone interested in economic trends, the silver story is worth following because it touches on so many important themes: resource scarcity, industrial transformation, the energy transition, and the stability of commodity markets. These are all significant issues that will shape our economic future. Subscribe to this channel if you haven't already, because I'll be continuing to cover developments in the silver market and other important financial topics. Hit the notification bell so you don't miss updates. And please, take a moment to comment below. Let me know what you think about what's happening in silver. Are you considering investing in silver? Do you already own physical metal or mining stocks? What questions do you have? I read the comments, and your engagement helps me understand what content is most valuable to create. And if you found this video helpful, do me a huge favor and share it with someone who might benefit from understanding what's really happening in the silver market. There's a lot of noise out there, a lot of hype and exaggeration. My goal is to give you accurate, data-driven analysis so you can make informed decisions. That's what the Money Aftermath channel is all about. Cutting through the noise and helping you understand the financial forces shaping our world. The silver market is at a critical juncture. The fundamentals have rarely been this compelling for a commodity, but as with any investment opportunity, success comes from understanding the situation, managing risk appropriately, and having the patience to let your thesis play out. Don't let fear of missing out drive poor decisions. Do your own research, understand what you're buying and why, and make sure any investments you make fit within your overall financial plan and risk tolerance. Thank you for watching. This has been another episode of Money Aftermath, where we analyze the aftermath of financial events and prepare for what's coming next. Until next time, stay informed, stay skeptical of hype, and stay focused on the fundamentals. The silver story is just beginning, and I'll be here to help you navigate it every step of the way. Take care, and I'll see you in the next video.